and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Suncor are rising today. You can see it's up about 2.5% right now. The energy giant says it has achieved its production targets 1 year earlier than planned. The Calgary-based company says the achievement was driven by record production in the fourth quarter of last year, as well as its best ever annual upstream production, refining, and utilization. Suncor will give more details on results and outlook when they release their earnings in early February. Copper is extending a powerful rally after topping $13,000 US a ton for the first time. Expectations that the Trump administration may introduce a tariff on refined metal have drawn huge volumes of inventory into the U.S. This has also potentially left the rest of the world short of the metal as miners struggle to boost output. Copper's role in high-growth sectors like renewable energy and AI infrastructure has also fueled demand. Gold Reserve says it is seeking to regain control of its assets after the regime change in Venezuela. The mining company operated gold and copper deposits, which were seized by the country's government. In an interview with Bloomberg News, Gold Reserve says it is already exploring deals that could help develop the deposits under a new Venezuelan government. One of the deposits is worth more than $40 billion US. And looking at the markets right now, TSX has a bit of a yo-yo day right now. It's in the green, not by much, about 0.14%. Energy is helping lift that up right now after that rough day for them yesterday. And south of the border, everybody in the green right now. It's calmed down a little, but they're still up. The rally continues to start the new year. S&P 500 up by 0.17%. Dow 0.27 into record territory, sitting around there, and the Nasdaq up by 0.12. Well, Canadians continue to react in the days following the capture of ousted Venezuelan leader Nicolas Maduro and his wife. For more on the reaction from Canadians and Prime Minister Mark Carney, we were joined earlier by CTV's Scott Hurst.
The main focus on the future of Ukraine, but he did comment as there is obviously a whole lot of reaction to the ongoing and the significant geopolitical upheaval with this U.S. operation capturing Venezuelan leader Nicolas Maduro. And this morning, Prime Minister Mark Carney commenting on that and obviously the impact it might have on Canada. Prime Minister saying ultimately the removal of what he calls an illegitimate leader is welcome news and creates the possibility of a democratic transition, which is a positive for the people of Venezuela, but also asked on the potential impact or the threat to the Canadian oil industry, with the U.S. president really pushing American oil companies to go into Venezuela and invest in the infrastructure, which could take a whole lot of money and many years to really bring up to speed. But Carney saying ultimately Canada has a competitive product, and arguing his government is pushing to find new markets. Not good enough, as we heard this morning, also with a letter to the Prime Minister on social media from Conservative leader Pierre Poilievre, saying recent events in Venezuela have altered the global energy landscape and is calling on the Liberal government to approve that new Pacific pipeline, which the government has signed a memorandum of understanding with the Premier of Alberta. He's calling on the government to approve that pipeline within 60 days of receiving Alberta's proposal. And so the Prime Minister is saying the product that Canada does produce is competitive, and arguing their government is pushing to create new markets.
Canadians across the country have been voicing their opinions since Maduro's capture. Summarize that if you could, Scott.
Andrew, there has been mixed reactions from Canadians. Of course, there are lots of questions in the international community about the legality of the U.S. operation in Venezuela, as the Trump administration is justifying its actions and potentially hinting at more military operations. Now, specifically when it comes to Venezuelans in Canada, Venezuelans in other parts of the country, country or Venezuelans still in that country. There is somewhat cautious optimism, as I mentioned, as the world debates the legality of the strike, and many are condemning the U.S. operation in Venezuela. And we heard yesterday Nicolas Maduro himself in a New York City courtroom claiming he is innocent and still the leader of that country. But for many who've suffered, Andrew, under his brutal regime, this is seen as a positive step. So there is hope potentially for the future of the country, for the people of Venezuela, expressing some cautious optimism today.
All right, that was CTV's Scott Hurst, and Canadian energy stocks are looking to rebound today after seeing significant losses yesterday in the aftermath of the military action in Venezuela. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay to talk about it. Lindsay, what are they looking at right now? We saw that reaction yesterday. A lot of them in the red yesterday, but a little bit of a bounce back? Or
a little bit, not too much. I mean, that's what we're waiting to see if maybe throughout the day, as Scott Hurst was just telling us, Prime Minister Mark Carney kind of trying to dampen those fears by saying he's not worried about Canadian oil. But yeah, we did see some of the stocks, some of the big names in Canadian energy dropping yesterday. If you look at this 1 week chart, you can see just that drop on Monday. Like Cenovus, for example, dropped by more than 5% yesterday. That's the most it's fallen in 9 months. And today you can see a little bit of a rebound. But look at that. It's for all of them. Like it's the same on Monday. Just a sharp drop. Suncor also back up almost 2% today, but it saw quite a drop yesterday as well. There you go. It's climbing. Enbridge, Canadian Natural Resources, if we take a look at those 1 week charts, you can also see, again, that drop is there and rebounding ever so slightly, and potentially more rebound to come after Mark Carney kind of again, saying that he's not worried, but it was interesting to see them take such a hit yesterday. The Canadian dollar also taking a hit because those fears are just there in terms of what's happening with Canada's oil and energy landscape. And what are investors looking at next? What's the concern for them? Well, the concern is, like we've been mentioning, right? Venezuelan oil is very similar to Canada's. It's heavy crude oil. And right now, most of Canada's heavy crude is imported into the U.S. to be refined. And obviously, if the U.S. is looking at Venezuela and those massive oil fields they have there as a potential new resource to bring in heavy crude oil, maybe they won't need as much of Canada's heavy crude oil, right? So that's kind of the fear that investors have. But we were speaking earlier today with Brian Madden. He was talking a little bit more about those fears and kind of the realistic situation in Venezuela. And here's what he had to say.
That's sort of a knee-jerk trader's response to something that ostensibly and superficially looks bearish from a supply perspective. And I think the fear that traders may have is that there'll be an onslaught of Venezuelan barrels, which, of course, are substantively identical to the heavy grade and slates of crude like bitumen that we produce in Alberta, and accordingly are going to box out or crowd out Canadian barrels from refineries in the Midwest and the Gulf Coast, which have been specifically engineered and optimized to run heavy slates of crude. And obviously, Venezuelan crude would have a shipping cost advantage. It's much, much cheaper to float the barrels by tanker to the Gulf Coast than it is to rail them or truck them down, or pipe them down, I should say, from Alberta.
So looking at some of those numbers from yesterday, just seeing how much those energy stocks dropped. And so on that note, in terms of what Brian Madden had to say, obviously, yes, there is potential that Venezuelan oil might eventually be more appealing to the U.S. But in the meantime, the infrastructure needed to extract all that oil is very, very outdated, should we say. It's a nice term. It's a nice term to say. It's decaying might be another one, I think, it's in need of an upgrade. Yeah. And Brian Madden was saying today the numbers that he's seeing in terms of how much it would cost to have those upgrades is somewhere between $90 to $100 billion. So it's not going to be a small feat. And that's why Venezuela produces such way less oil than it used to, is because it doesn't have the infrastructure in place to do it anymore. So it would be a lot of money to get it up and going. It would take a lot of time. I know we had some economists on yesterday saying anywhere between 6 to 10 years is what they're thinking. So maybe in the long run, there might be some concerns, but in the short term, over the next decade or so, a lot of economists are saying there's probably not a concern for Canadian oil. Okay. Lindsay, thank you as always. Thank you. BNN Bloomberg's Lindsay Biscay. Up next, we'll get a broader market outlook on the latest buzz happening in the energy sector. That's Manulife's Nate Tuft. Well,
The Canadian energy sector is looking to rebound today following significant losses yesterday in light of news coming out of Venezuela. Let's get more on how this impacts the broader markets from Nate Tuft. He's CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us. It looks like things are kind of coming back to normal. People are sitting and thinking about things now and realizing this is probably a long-term situation.
Yeah, 100% agree with that. I mean, the reality is, I think the market in general is looking at most of these risks and uncertainties that are developing across the world as a half-glass full type of opportunity set. And I think Venezuela is another example of that, where yesterday you were looking at certain companies, particularly some of the U.S.-based oil names, as well as some of the industrial names, benefit a lot with the perspective that longer term or even nearer term, you might get some benefit and some additional spending from the Venezuela situation, which at the second hand impacts more negatively some of the losers, which the perception was that might be some of the Canadian plays. The reality is this is a very long-term issue, as we're talking a decade, because it will take a very significant amount of dollars as well as time to really change the infrastructure within Venezuela.
And do you think we'll actually see that unfold? I mean, oil companies by their nature are fairly cautious. They look long-term, but they also have the political pressure. Do you see them moving ahead with it? I mean, Chevron's there, but other groups were there earlier. Can you see them going back in?
I think the administration has the intentions to help facilitate that. And I do think the companies, particularly some of the names that have operated there or currently do operate there, would like to operate there under a more stable type of political environment. And if they're incentivized to do so by the U.S. administration to do it, I think that's another benefit for them. And the proximity is not that difficult. Obviously, the infrastructure requires a lot of effort to rebuild it, and it's going to cost a lot of dollars from a reinvestment perspective, both on the part of the big oil companies as well as other names. But the reality is there is a very large oil reserve there that is underutilized. Venezuela only generates about 1% of the entire global output of oil. When you think about that relative to its own history, it's very low, but relative to just the absolute level, it doesn't move the dial from an oil production perspective today.
So what does this mean then for Canadian energy, Canadian oil? I mean, there's been so much comparison about the oil in Venezuela, the oil in Alberta, very similar. And are they competition for us now?
I think it means nothing in the next 5 years. Longer term, yeah, it does have an opportunity to create another competitor to Canada. But at the same time, Canada has options too. Canada can look to find other exporters to take their oil as well. And they've tried to do that over the years. So Asia is another opportunity for them. Obviously, that comes with some infrastructure build out as well. But it will be competition potentially for Canada if Venezuela does become more up and running, more stable, and has the infrastructure in place. But again, this is a 5 to 10 year type of dynamic before it becomes a reality, even the beginning stages of reality. So I don't think it has a lot of meaning other than sentimental and kind of fear meaning in the short term as it pertains to what the impact is to the Canadian names in this space.
Now, there's been a lot of focus on AI, on energy with everything that's going on with AI, the need for energy. Is that the best place to be, or are you looking at, do you see alternatives?
So when we think about the sectors, there's a number of areas that we see opportunity. And the one area where I think overlaps very well with both energy as well as this idea of infrastructure build out is the industrial sector. So the industrial sector has a couple big benefits going on. One, even yesterday with the news about Venezuela, there was some benefit within industrials because there might be the perception there'll be some spending of new infrastructure build out for energy. Again, longer term play. At the same time, the industrial sector was benefiting from defense plays, which has been a pervasive benefit over the last kind of year or two as we see greater spending from a government perspective across the globe when it comes to defense spending. Most of those names live in the industrial sector. And then last but not least, but probably the most important, is a number of industrial names benefit from the build out of AI spending and the infrastructure required to do that. So if you're trying to play the energy space and some of the infrastructure, we think taking the other tailwinds coming from AI spending as well as defense spending, packaging them together and looking at some high quality industrial names is probably the best way to play it.
Okay, and also you're saying look outside of North America as well.
Yeah, a few other areas we like outside of North America. We do think there's opportunities still within the Japanese market. It's off to a good start this year in the first couple of days, but we do think there's some real valuation opportunities there. There's some secular trends in place. There's governance trends in place, improving margins, a lot of companies, potential for M&A activity, et cetera. We're also like some of the areas in emerging markets. I think China's increasingly looking better. Some of the worst of it is behind, even though there are still some concerns around property. There are some real benefits from a stimulus perspective coming in. And then also more broadly throughout emerging markets, there's opportunities as well, partly driven by their own tech AI spending initiatives that are focused on building out the infrastructure of tech across the emerging market world.
With Japan, any concerns with the yen?
The yen is always a bit of an interesting dynamic when it comes to Japanese stocks. Japanese stocks like a weaker yen. But that doesn't mean it has to be pervasively weaker. I think as long as you have a more stable yen environment, even if it's a modestly appreciating yen because they are trying to normalize monetary policy, as long as it's gradual and somewhat stable and doesn't happen quickly, the yen should not have a meaningful negative impact on the stock market there. The challenges arise when you have very sharp moves in the yen that drive the perception around the stock market in Japan.
Okay, we'll have to wrap it up there. But Nate, thanks as always for joining us. Happy New Year to you.
Thank you.
Nate Tufte, CIO and Senior Portfolio Manager at Manulife Investment Management. Coming up, today's market drivers with Bloomberg's Monique Molina. For a look at some of the drivers on the market today, we're joined by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. Let's get right into it. First up, you want to talk about USA Rare Earth and Critical Metals Corp.
Hi, yes, thanks for having me. So USA Rare Earth and Critical Metals Corp, they are both up this morning. We've seen that China has put in place some new export curbs on Japan, and that's also going to affect China's exports of critical minerals and rare earths. China currently has the most of these in the entire world, so this could potentially cause a bit of a squeeze in Japan for these critical minerals. So that's helping some of the domestic U.S. producers and Canadian producers of rare earths. And they're also getting a boost today off of Venezuela. China also came out criticizing the U.S. Capture of Venezuelan President Nicolas Maduro. And as a result, analysts are saying that there's now rising tensions between China and the U.S. And the U.S. has already been focused on growing its domestic supply chain of rare earths, recognizing some of the risks that come from being so reliant on China for these critical minerals. And now this is just pushing it even further. And analysts are saying that this is going to put more of a focus on that. And some of these U.S. And Canadian companies could benefit from this.
Okay, Halliburton up next, and it's a bit of a mix for it. It's an upgrade and a downgrade.
Yes, so Halliburton, they were downgraded at Evercore today on some of the outlook for U.S. energy. The oil market is expected to see some declines this year in terms of their pricing because of fears of an oversupply, and this is expected to be worse in the U.S. and North America compared to places like the Middle East. Halliburton has more exposure to North America compared to some of its peers, so that's why analysts have some concerns on the outlook for this year. Even as the company, they say, has been making progress with cost cutting, they're still going to face some of these more macro headwinds, and they say that this is going to affect them, and the company might have to reduce some of their exposure on this. And this could help them with their margins if they, again, move away from this North American market that's a little weaker, but this could also impact revenues in the short term.
All right, and I got to correct myself. There wasn't an upgrade there. I was reading two different things combined. My eyes were a little too tired to see that properly. Okay, Sunoco, what's up with them?
So Sunoco, they gave their 2026 guidance today. The fuel company is expecting to see up to $3.3 billion of adjusted EBITDA for the year. And analysts see this as kind of neutral. Some may be saying a little negative. It's about in line with consensus, but some had been hoping for something a little stronger. And one of the main focuses is also the company's guidance for its capital expenditure. It did come in a little higher than some analysts were expecting, as the company plans to spend more this year. And part part of that spending is also going to be on mergers and acquisitions. They're expecting about $500 million annually on M&A. And analysts are saying that this might also be a little conservative. The company could end up spending even more than that. So that's why we're seeing a bit of pressures on shares today.
Okay, and we're going to sneak in one last thing. Copper stocks, everybody's talking about copper right now.
Yes, so copper hit a new high. Copper futures rose to over 13,300 in London. And as a result, the copper stocks are higher today. There's been ongoing fear of a potential copper squeeze that's been helping the stocks over the past year. And they're also getting a boost on some of the news out of Venezuela as well. We're seeing all of the metals rising on this as people are looking for more safe haven assets, and that's helping those copper stocks as well.
Okay, we'll have to leave it there, but Monique, thank you as always. Bloomberg's Monique Malima. After the break, we look ahead to the Bank of Canada's first decision of the year happening this month. RBC shared its insight on what it's looking for. That's next with Claire Fenn. Quantum computing startup Photonic raised $180 million after new shareholders Royal Bank of Canada and TELUS joined existing backer Microsoft. This marks the first direct equity investment in a quantum computing company by RBC. The Vancouver-based company says its valuation now considerably exceeds $1 billion. Quantum computing technologies have been attracting global investments on their potential to work exponentially faster than classic computers. Prime Minister Mark Carney says Canada is working to expand oil markets in Asia. Talking to reporters in Paris, Carney said he sees Canadian oil as being low risk compared to Venezuelan, which will help it remain competitive. In a social media post, Conservative leader Pierre Poilievre is urging the Liberals to immediately approve a pipeline to the Pacific coast on the possibility of an end to American sanctions on Venezuelan oil. Gold Reserve says it is seeking to regain control of its assets after the regime change in Venezuela. The mining company operated gold and copper deposits, which were seized by the country's government. In an interview with Bloomberg News, Gold Reserve said it is already exploring deals that could help develop the deposits under a new Venezuelan government. One of the deposits apparently worth more than $40 billion US. And looking at the markets right now, the TSX back up in the green, 0.14% it's up by right now. The energy sector, some of the oil companies bouncing back after that drop-off yesterday. Looking south of the border, and you can see everybody in the green down there. Another good day. The rally continues on both sides of the border. S&P 500 up by 0.2, Dow Jones 0.47, and the NASDAQ up by 0.11%. Well, one of Canada's big banks, RBC, says the December job numbers are a key input for the Bank of Canada's upcoming decision. Let's get more on this from Claire Fenn. She's senior economist at RBC. Claire, thanks as always for joining us.
Thanks for having me, Roger.
What are we looking at for the numbers right now?
So headline numbers, we are expecting a 35,000 loss in employment, as well as a tick higher in the Canadian unemployment rate to 6.8%. Now, on the surface, these numbers might indicate a pretty significant softening in the labor market in usual times, but it is the context that really matters, which is, between September and November, what we saw. And what we saw was consecutive strong gains in job market, 180,000 just over those 3 months. So what we're expecting for December, is a partial reversal of those solid sort of trend. And it will really leave the jobs market still quite a bit stronger relative to where it was a quarter ago.
I mean, those were really unexpected, those numbers we saw. Is this just more of a reality check?
Yeah, absolutely. I mean, again, 180,000 job growth that we've seen over the past 3 months between September and November. And if we were to look at where the job growth has been coming from, we've seen a lot of, increase in part-time jobs, increase in younger workers as well, which could indicate that to some extent, maybe the gains have been boosted by challenges with seasonally adjusting the data around holiday hiring periods. But we've also seen fairly strong job growth growth in healthcare, which is not typically a cyclical segment. But more importantly, I think for us is signs of stabilization in some of the more trade exposed sectors, and these include manufacturing and transportation and warehousing that are combined have actually accounted for over 50,000 of the 180,000 gain that we've seen over those months.
So I imagine a stabilization in those sectors will be a good thing right now, considering everything that's been unfolding.
Yeah, absolutely. I mean, towards the end of 2025, I think we were really starting to see really good signs. I mean, the job reports apart, hiring demand indicated by job posting data has started to come back. And throughout the year, again, Canadian consumers have been behaving fairly resiliently throughout. Towards the end of last year as well, we ourselves at RBC actually tracks consumer spending. I've seen a huge surge around sort of the holiday discounting periods, just ahead of the holiday period. And of course, there were idiosyncratic events as well. I don't know if you still remember the Blue Jays postseason runoff as well. So there are a lot of reasons, to expect some cautious optimism for the economic backdrop as we head into 2026.
And I just want to go back to for the expectation for the December numbers. You expect a drop off for part-time and younger people after the nice increases that they've seen. Wouldn't December be one of those months that those would be people that would be finding jobs?
Yeah, absolutely. So that's why we're not expecting a full reversal, but merely a partial reversal. And again, our expectations are relatively softer comparing to market consensus, which are expecting also a job loss, but much smaller, -5 versus 6.7 unemployment rate.
And then heading into the year, any indicators where the unemployment rate might go? There's so much possibly coming up this year, isn't there?
Yeah, well, we are expecting, still broad improvement in the Canadian labor market, and that the unemployment rate will start to gradually tick lower to 6.3% by the end of this year. So that is our expectation, and that is also very much in line with what the Bank of Canada has been, communicating in terms of their expectation for the economy in 2026. Now, they don't forecast the unemployment rate itself as an indicator, but they do see labor market indicators as very important input into their decision. And we know that because in the December meeting, they specifically mentioned, recent improvement in labor markets, but also softer hiring demand going forward. So I think this expectation for a gradual kind of recovery in the jobs market it's very much in line between us as well as the central bank.
All right, and then that segues nicely into what can we expect from the central bank, do you think, for the next for 2026?
Yeah, so I love how you phrase the question, which is not what we expect from them from January, the next meeting, which is not a lot. The question really is, what do we expect from them for this whole year? And I think the key to that question partially is tied to some of the numbers that we will see coming out of this Friday's report, mostly around the risks. So we are expecting a softer report, and the Bank of Canada likewise will likely be holding similar expectations as well. Now, I would say that if this report comes in more solid, if this were to be a fourth consecutive strong job gain, the implications will be much more meaningful for the Bank of Canada, who tends to view this data on a longer term 3-month horizon, because it's telling them the improvement in labor market is indeed coming in a bit faster than they're expecting. And that could risk pulling some of those discussion around rate hikes, which we expect will be in 2027, earlier into 2026. Now, that compares to downside, which are weaker numbers than what we're expecting right now, which could be less meaningful from the Bank of Canada's perspective.
Okay, we'll have to leave it there. Always appreciate talking to you. Claire, thank you for joining us.
Thanks for having me.
That was Claire Fan, Senior Economist at RBC. Coming up, we'll hear from the author of a new book that explores how to navigate finances as a single person. Stay tuned. The singles tax refers to the financial burden singles face without the cost-sharing benefits of living with a partner or family. That's the focus of a new book out called The Singles Tax, and it's out today. For more on it, we sat down with author Renee Sylvestre Williams to discuss what it means, how singles can also manage their finances, and how tax codes could better support them.
The number is almost 15 million Canadians identify as single, according to the last census. So that's a lot of money.
And so why do we see breaks going for families and not as many available for single people?
Well, keep in mind that the society that we live in does benefit couples, right? So like the tax regime, everybody files individually, but couples benefit from it. There's income sharing, spousal RSP support, and all of those things. So if you are single, you do not benefit from that.
And are there any benefits for single? Is there any benefits to being single?
I mean, there are the standard, maximize your tax deductions, medical expenses, maximize your RSPs if you can. But, we can't split income.
And what about when it comes to investing? How do you approach investing if you're single?
Well, if you're approaching investing, there's obviously, the earlier you do it, the better, obviously, because, it's time in the market, not timing the market. And then also making sure that you are planning for your short, medium, and long term. So in the book, I advocate for having a team of experts who can help you with this. So it might be a case of maybe you need a slightly bigger emergency fund. You might need more liquidity for things that you need. And then you might need more downside protection as you get closer to retirement to protect your investments. And then, there was a recent opinion piece in the Globe and Mail that I am completely aligned with, where one of the suggestions were, if you are fortunate to be a single person who has quite a lot of investments or quite a big retirement fund, perhaps reducing the yearly withdrawal limit on your RIFs could be an option.
Renee, did your research identify that there were geographical disparities in the prevalence of single people and the size of the singles tax or the financial disincentives for being single? For instance, is there an urban versus rural split or anything else of regional note that you think would be interesting to share?
I didn't find any data on an urban and regional split, unfortunately, but you can possibly operate on the assumption that people tend to move to more urban spaces, obviously for the start of their career, tends to be where the businesses are. So while I couldn't really find information on that, we do know most Canadians tend to live in more urban areas.
Or maybe a corollary or follow-up question, if I may, is there anything demographically, like by age strata? For instance, does the single tax compound with time the longer someone stays single? And does the data indicate that people are purposefully and deliberately staying single lifelong, or are they just delaying marriages or coupling up as they pursue higher education and kickstarting their careers?
That's a great question. So I'll answer the delaying part. Yes, there are indications that people are delaying marriage. They're probably looking more into cohabiting, apologies. And also there is a movement around younger generations to, stay single longer, understand who they are as single people. Now, in terms of, I'm sorry, could you just repeat the first half of your question?
Just wondering if there was any evidence that the singles tax, is larger in older or younger cohorts, or if it compounds and grows larger over time the longer someone remains single.
It can compound the longer that you remain single, because you have to consider the fact that there's also outside forces such as, caregiving, for example. That is a billion-dollar industry, unpaid industry in Canada, right? So if you are single and you are caregiving, say, for a family member, an older family member who is ill, you might be out of the market longer. So that is reduced income, which means reduced money that you can put towards retirement, right? Which means possibly you could end up with lower RSP, lower RIFs, lower retirement fund, lower income, because you're not working, and you could possibly be missing out on promotions. You could be missing out on raises. So there are a lot of external factors that can compound the longer you remain single. Plus, we are in we're in an area now where there's possible job loss due to things like AI and how the economy is looking. And when you are single, even if you have an emergency fund and have access to EI, you also don't have that second income to fall back on. So there's that anxiety that comes with it as well.
All right, just one last question. What made you write the book, and would you like the government to read it?
Okay, yeah. Yes, I would love the government to read it. So you know where I am. The books are available now. If anybody in the government is looking at this, please read the book. What made me read it? Okay, so it was 2020. We know what was going on at the time. I had some time to myself because it was 2020, and I am single, and I was thinking about all of these questions. So I started a newsletter 5 years ago, The Budget, which addressed these questions, because I figured if I had these questions, other people would. And as a result of that, almost 6 years later, there's the book, The Singles Tax.
Renee Silvestre-Williams is the author of The Singles Tax. Coming up, we'll get some investing strategy tips for 2026 from Brent Joyce. He is the CIO and Chief Investment Strategist at BMO Private Wealth. While many stock exchanges pull out all the stops to attract IPOs to their venues, employing lasers, gongs, dancers, confetti, and more. It's a good time, but it's also serious business as exchanges compete for a dwindling number of listings in recent years. Bloomberg television anchor Tom McKenzie takes a look at some of the entertaining ways initial public offerings are celebrated.
An IPO is often the pinnacle of success for executives. There are speeches, hugs, even tears.
I achieved my dream.
The champagne and confetti and countdown clocks might look like a nice party, but it's serious business too. Listings have been dwindling in recent years in the aftermath of COVID and rate hikes to tackle inflation. Exchanges have been competing for a shrinking slice of that pie, and a good show is part of the marketing.
Part of getting the message out is a way that we effectively live the stories that the companies execute through the medium of an exchange. And yes, of course, it reaches out to companies which may be within an IPO pipeline.
Asia has dominated listings for the last few years, and its listing ceremonies mix tradition with pomp and some fun. In Hong Kong, there are gongs of different sizes.
So that's the standard size gong. We also have a bigger gong or a mega gong. That's for very special and larger companies listing in Hong Kong.
So little surprise then that when China's CATL sold shares in May, raising a whopping $5.3 billion, no ordinary ceremony would do for the world's biggest maker of EV batteries. The Hong Kong Exchange wheeled out its mega gong. With CATL shares handily beating global benchmarks since the listing, fortune has indeed been kind to the company. As Europe and the US look to rival Asia by claiming more new listings, the pizzazz, showmanship and company mascots show no signs of being canned as trading gets underway.
And that was Bloomberg TV's Tom McKenzie. Well, markets are still making sense of the capture of Venezuela's now deposed president, Nicolas Maduro, by U.S. forces. We got some perspective on where markets might be headed. Joining me is Brent Joyce, CIO, Chief Investment Strategist, BMO Private Investment Counsel, and BMO Private Wealth. He joined us earlier.
These geopolitical events are something that, unfortunately, we've becoming to have to get used to as investors. The market reaction was largely to pass through it and focus on what markets truly care about, and that's global economic growth. And there were some nice results over the past number of days through the purchasing manager indices that showed an uptick in the manufacturing space, a little bit weak on the one survey in the U.S. on the ISM. And so the capital markets are taking a pass, I would say, really on the sideshow that is Venezuela and Trump.
You say that it was surprising how resilient economies and stocks were last year when you think about threats such as tariffs, but you see some big T's towards the end of the year. Turnaround, terrific, and all-time highs. The market sure rejoiced towards the end of 2025.
Absolutely. We characterized last year with two words, resilience and feedback. And the resilience was certainly the way that consumers continued to power through globally, despite the fog and certainly the disruption and the rewiring of global trade, but also businesses. A lot of it, yes, is the artificial intelligence capital expenditure story that has driven the market last year. But we're anticipating and looking forward to a broadening out for the global economy. And that's something like, you'd see yesterday with oil prices moving higher. That is a sign that we're expecting, an uptick in global growth.
So the projection for the global economy growth of more than 3.2% for this year?
Yeah, anything above 3 has been a decent number over the past decade. And so it's always about expectations versus surprises. And we know the U.S. economy has been running very hot and continued to run above expectations last year. But the Canadian economy came out surprisingly strong with the back half of the year last year, improvement in the Eurozone. Also coupled with, I think, what is a change in attitude, forced in large part by some of the geopolitics, with this fiscal spending push that we're going to be seeing in Europe, in Canada, nation-building projects, defense spending, and the Chinese are continuing to stimulate their economy as it has been moribund for a number of years, as we know.
What are your thoughts on tech stocks this year, Brent?
Yeah, I think we're going to have to move from just the AI innovator hyperscalers and start to think about the adoption and the spread of this technology across the economy. When you think about general purpose inventions over the centuries, the big, huge rewards obviously go to those who innovate and discover these inventions. And we've seen a lot of that. That would be the NVIDIA example. But the productivity gains have to come with adoption of the new technology across a whole variety of bread and butter, normal, everyday Main Street sectors for the economy. And I think that's going to be the story for technology this year. And that's going to involve more of not just the technology space itself, but a broadening out where we can see productivity gains in other areas like financials and industrials, you name it, really, healthcare.
I wonder, there seems to be evidence that companies in many cases have been slow to realize productivity gains from AI investments now. I know it's super early days. We're just at the dawn of this thing. But is there a risk that investors will decide, hey, this is going to take years to play out maybe, and they'll deflate some of these AI-related stocks?
Yeah, I think there is a risk that we've straight line extrapolated some of the opportunity in some of the businesses. That's, again, not unusual for new technologies, new inventions. You do get some sort of over-enthusiasm. That is what drives the reward and the attraction for the technology to be adopted. The interesting thing about productivity, it's a nebulous concept. It's very hard to see it and to measure it in real time. It is often only observed in hindsight. We've seen strong productivity gains in the U.S. economy for a number of years, and that isn't just the AI story. And so I do think there are productivity gains happening in the economy beyond just artificial intelligence, whether that's automation or other adoption of technology that's a little bit more mainstream and has been here for a while.
You're so right. We bandy, I love that word, bandy. We bandy around terms like productivity. And what exactly does that mean? Yeah, I suppose in some ways it's extra work you can get out of each employee. Leave us with a final thought, Brent. I may have asked you this before, and I'm sorry if I have, but do you think there's some risk, some iceberg out there in the mists in 2026 that we should watch out for?
Listen, I think we always have to be on guard for black swan events. If we knew what they were, we wouldn't call them black swan events, right? But when we look at the various fundamentals across the economy, the consumer, debt levels, what businesses are up to, the exciting things that are happening in technology, opportunities for a rewiring of how we do business. One of the things I think that really was proven last year is the business of the world is doing business, and it can adapt and move forward businesses and households once it has some understanding of the rules of the road. And I think there'll be less fog if there's an iceberg, hiding out there. We might see it sooner because there'll be less fog from the geopolitics and the trade rewiring. What should investors do, I think, is to make sure that they keep their risk tolerance in check. One of the things that can happen after 3 years of very strong markets is we all think we're investing geniuses. And we see our risk tolerance creep into an area where we we may be uncomfortable if we really truly ask ourselves, what would happen? What would I do? What would my reaction be if the market went down 10 or 15 or 20%? And if the answer is that you're going to panic, then you should probably do some rebalancing in your portfolio. It's referred to as bull market genius. Everybody's an investing genius when markets are going up. And so check your risk tolerance, take some profits, be disciplined. And I think that's the best way to navigate if there are icebergs hiding out there in the fog.
Brent Joyce is CIO, Chief Investment Strategist, BMO Private Investment Counsel, and BMO Private Wealth. Market Call is up next, and today on the show we have Matt Kaser, President of FSA Valuation Service, his focus, North American equities. And let's take a look and see how the markets are performing on Bay Street and Wall Street. First up, we got the TSX, and you can see it's back up into the green again, continuing the rally that started on the first day of trading. And one of the companies of note that we want to take a look at is Suncor. Yeah, it's RBC maintaining Suncor's energy outperform rating. Suncor provided an operational update just recently that had a record quarterly production, 909,000 barrels a day for the fourth quarter. And it also beat RBC's estimates of barrels a day and had some other good numbers there. And taking a look before we go quickly down south of the border, and you can see the American markets also rallying right now. All of them are in the green. One worth noting, though, quickly, a couple of groups taking hit, Johnson Controls and Modine as well, over Jensen Huang from NVIDIA saying they may not need chillers when it comes to cooling their chip production. Thanks for watching Morning Markets. We'll see you tomorrow.